Okay, let's get to some questions from Sunday's market outlook. Why is debt issuance declining? Is it because of higher interest rates discouraging the public and private sector from borrowing? Public meaning government. The government doesn't really care too much about interest rates. If they need money, they just go and borrow. The reason government issuance is declining is because tax revenue has been increasing. So when you have wage increases of 5%, 6%, 7% year over year, well, you don't have to raise your tax rates to raise your tax revenue because that wage gain you got gets taxed. Higher prices that you pay in the store, if there's a state sales tax, well, tax revenues go up without tax rates going up. So tax revenues, this is what inflation will do. It'll increase tax revenues and result in less issuance. As far as the private sector is concerned, the higher the cost of debt, the less willing companies are to invest. Not only that, as interest rates are going up, there is a belief that it will push the economy into a recession, and companies will say, instead of investing in something now, instead of investing in new assets now, let's wait a little while or wait till after the recession, and then we'll get more clarity on the level of demand. B, took me a while to figure out what this one was saying. I'm long dollars because I see the Feds are still hiking a regime mode and because of the uncertainty about a recession, but at a slower pace. I think the market is wrong. I'm not sure what's happening at a slower pace. If you think the hiking is a slower pace or the recession is going to happen at a slower pace, either way you think the market is wrong, so you think there's some DXY strength. It doesn't matter if they're still hiking. That's not what causes would cause the strength in the DXY. It is the interest rate differential, because a currency A is always traded against another currency B, and it is the interest rate differential between the two that determines which one is going to get bought and which one is going to get sold. So even though A, US, may be raising rates, what if B is raising rates at a faster rate? Well, the interest differential would favor B. So it's not one interest rate. You have to look at two interest rates and look at the differential between those two interest rates. So if the Fed is going to slow down like this and go sideways while other central banks are still going up, it's that differential that is going to affect the DXY. Still long dollars. I want to hedge my downside risk because I see some choppiness, but not a sell-off. Well, then you can if you see some choppiness and not a sell-off, just live through it. You don't have to protect every penny move, right? So how could I hedge? I'm currently day trading gold futures to hedge by buying gold futures daily to capture the upside in it. How do you know you're going to capture upside? How do you know that you're going to capture upside? What if you get downside? What if you hedge and you lose on gold but earn on your long dollars, and you've just given up some gain? I'm not quite sure how you're just getting upside in this. And if you are day trading gold and only winning, there's your career. I doubt that that's true though, but I feel that's a little riskier. Is there a cheaper way to do this, like with selling puts and selling calls again? Well, I don't know that you want to sell puts, and I don't know that you want to sell calls. Selling calls limits your upside, and if you think it's going up, I don't know that you'd want to sell calls. Selling puts gets you some income, but what if you're wrong on this and you were looking at interest rate hikes instead of interest rate differentials and you're wrong? Now you're going to end up with double the amount of long dollars. So what you want to do is you want to find something that you don't have to stare at the screen all day long and chase pennies around the board to try to protect yourself. Is you want to find something that will go up when the DXY goes down, but is still a fundamentally good thing to be in anyways. And that would be the Mexican peso. Mexican peso outperformed the DXY when the DXY was increasing. It outperformed the US dollar all year long, the Mexican peso. Odd, isn't it? And since the DXY is broken, the Mexican peso is heading towards 19 and may print an 18 handle soon. I think it may print an 18 handle soon, which I said that a couple of months, I think maybe a month back or a month and a half back, I felt that the peso could print an 18 handle. It was 20.2 to 20.1. Now I think it's 19.2. That's a big move on the peso. So if DXY has weakness, the peso will increase because the other side of that is the US dollar, right? And if the DXY does go up, the peso has shown itself to be able to go up even as the US dollar has strength. So you hedge yourself on the DXY by being long the peso, and you don't have to stare at the screen all day long. C, going through level 3 CME readings, and we cover the yield curve and how an engineered yield curve is an unreliable indicator. Do you still consider the current yield curve to be engineered? Well, the money market rates are, because the Fed is raising rates. We don't have a market-determined interest rate structure per se. The Fed manipulates the overnight rate, or at least targets an overnight rate, and then all the other rates are market set based on that. So you could, in essence, say, well, we do have a market rate, but it is determined by the short rate. They are allowing Treasury securities to run off and buying less and less. They're an price-insensitive buyer when they buy. So when they do buy, yeah, it is manipulating the price signal that the yield curve gives, because they're not making rational purchase decisions. They're just doing it based on some process or some system, and they don't really care at what yield they're buying at. So it misprices risk. When interest rates were held very, very, very low, risk was mispriced, plain and simple. It's less mispriced at this point. I think risk is more appropriately priced on the longer end of the curve, and I think that risk is more appropriately priced when we start looking at credit spreads, that it is more market determined now than low interest rate environment determined. So it's less engineered, but at any point, with having control of the overnight rate, anything other than a neutral rate for a long period of time would have some kind of engineered shape to it. The Fed spent many years buying government bonds. Now they're offloading just a fraction of these through QT. It may be a shortcoming in my knowledge, but I don't see how this is sustainable, nor do I see how they can fix their bloated balance sheet. I'm not sure what you think is sustainable, the slow speed or just the offloading of them to begin with. I'm not sure what you think is not sustainable. Is the size of their balance sheet a systemic threat? No. Is QT the only way for them to reduce their assets? Well, reducing assets is called QT. It's when you say, are you reducing your assets, that is called QT. There are many ways to get that done. You can actually sell them, or you can just allow them to run off. But let's go back up here, right? Issuance of treasuries have been declining. And the Fed has allowed its balance sheet to run off. It's not as if issuance of treasuries are declining and the Fed is no longer buying them, and you have this gap that needs to be filled, and it's getting harder and harder to fill it. Every time the Treasury sells securities, the bid to cover ratio is 2.5 to 3 to 1, which means there's $2.50 being bid for every dollar of issuance. So it's still well bid in terms of being taken up by the market, but there's less and less of it being issued. So you don't want a big buyer in there. You want the market to be buying this stuff and not the Fed. So as long as this continues, as long as the issuance continues this trend, yeah, this is sustainable. I think they can continue on without causing too much of an issue. What would be difficult to sustain is, let's say that Treasury issuance was flat and the Fed was rolling off its balance sheet and there was not enough demand coming in to pick up those treasuries. Then you got a bit of a problem. Once the bid to cover ratios start heading down towards 1, that would signal that there is a bit of a problem there. But right now, nope, I don't see a problem right now. Could a problem arise at some future point? Sure, but I don't see a problem right now. If I were going to point to a problem, I wouldn't say that it's in the Fed balance sheet. I would say it's in the drop in supply in fixed income that is happening right now. At some point, that may cause an issue. Finally, volatility is coming down. Option prices deflate, making selling less attractive and buying more attractive. If you thought IYR is going to hit the 75-ish, why wouldn't you buy puts at this point instead of selling calls? Because they have a dividend, and they have not just a small one, but they have a monthly dividend that is significant enough, and the dividend will make the puts more expensive because stock price rise, pay a dividend, stock price rise, pay a dividend, stock price rise, pay a dividend. Notice that every time it pays a dividend, it's downward pressure, which for stocks like this, you'll find that if you find, let's say IYR is at 85 and you go to 90 and 80, $5 out each way, that the call will be way cheaper at 90 than the put would be at 80. You'll pay a lot for the put because you're paying the present value of the dividend in that put, or most of the present value of the dividend is in the put. So it doesn't make a lot of sense. If you're selling calls and you're selling in the money calls, most of it is going to be intrinsic value anyways, so the time value component is very small, which means it's not going to be affected that much by implied volatility because most of what you're selling is in the money. And I've sold $80 calls, and I am selling $88 calls on IYR as well. I don't know that I'll hold them all the way to expiration, but the dividend yield is simply just too low on IYR, meaning that the price of IYR is still too high given the components that are in there. I think the days of REIT dividends being 3 and 4% are over. REIT dividends, because they're fully taxable as income, should be closer to what interest rates are, 4.5%, 5% at least, at a minimum, if not higher. But I think the 7 to 8% range is the right place. Okay, on your IYR comment regarding the dividend yield being too low, how does that relate to the stock price? Are you saying that you anticipate a higher dividend yield, therefore decreasing the stock price? You have it backwards. I'm anticipating a lower stock price, thereby increasing the dividend yield. Is it likely that they would be increasing their dividend when constituents within the ETF are not doing so well? A yield is a ratio, right? It is the dividend divided by whatever the price happens to be. So when I say the yield is too low, it's not that I'm talking about the level of the dividend that you get. I'm talking about the price. If the price is high, you have a low dividend yield. So if the price drops, you have a higher dividend yield. And given the nature of the constituents, with many of them being REITs, the type of income you receive is not a qualified dividend. And I think that cap rates are still a little too high. So I think they have to come down somewhat. And in the past, when the dividend yield on IYR has been this low, it has always led to a price decline. So I think that there is some downward movement of the price that's needed before it becomes attractive. But again, that's my opinion. That doesn't mean the market shares my opinion. If I'm not mistaken, your 2023 L1 reading videos should have a new chapter on business models. Yeah, that is in the corporate finance section of level 1. It's something I never truly understood. Like everyone, I've learned about the business model canvas, but I wouldn't know how to describe one to save my life. I was asked what I thought of a company's business model, but really have no idea how to analyze and describe one and its investment implications. Business model is you're answering a simple question. How does this company make money? So let's take Robinhood, for example. What's its business model? Its model is free trading, but it sells all of its order flow to Citadel. So you can trade on Robinhood for free, but Citadel is going to know what your trade is before you actually execute your trade so that they can step in front of you and trade, which means that they'll try to shave a penny or half a penny off every trade and take it for themselves. So you're trading against the machine. That's why it's free. That's their business model. What is the risk to their business model is Congress may decide that selling order flow is not in the investor's best interest. The SEC might decide that it's not in the investor's best interest and then regulate that such that a broker cannot sell order flow. And where does Robinhood make its money now? That's the threat to the business model. So a business model is simply, how does this company make money? So some companies make money by giving away the asset and selling as a replacement for the asset. For example, razors versus razor blades, printers versus ink. So it's just a matter of looking at a company and saying, how does this company make money? And that includes the whole supply chain. Maybe they're completely vertically integrated and they own everything in their supply chain. Maybe they're very asset light and have very high variable costs but very low fixed costs so that they can scale up and down with the market very easily. Maybe they have a heavy asset base and very low variable costs such that any growth is fantastic to them, but any contraction would hurt. So really, that's all a business model is how does it make money? Thank you for sharing your view again. I have mixed feelings in the market, net short position. 3 questions. Could you share the link for Treasury volatility? I tried these links but unable to find it. I did leave a comment for you just a few minutes ago as I was doing this video. I left a comment for you of how you can link to it. You should open an account with CME. It's free. Just register for an account and you have access to a whole bunch more information, and then just take a couple hours and explore what's there. And they have a whole education series as well, some 660 some courses. They're all like 45 minutes long, and you get little certificates for completing each one. And they're not going to make you a good investor, okay? But they'll help explain a product very well. Or what a term means or what something means. So you can spend hours on that site. GDP now from Atlanta Fed shows 4.3 for Q4, which is also above blue chip forecast. Could you share your thoughts on that? This is just model driven. This is not an analysis that is thought out. It is a model, and as data shows up, they put the data in the model. So every quarter they start with what trend growth in GDP should be. And as data comes in, it will either increase it or it will decrease it. So at this point in time, let's say this is the three-month period. So at this point in time, new data comes in, it will either increase it or decrease it or increase it. Get to this point in time, if we're over here, it can either increase or decrease as the data comes in. So as more time passes, it gets closer and closer. Also, let's keep in mind that we have some accounting issues in GDP because you have huge volatility in some of the components. That's going to cause some accounting issues. We've seen that inventories from Q1 and Q2 distorted what GDP was, that once we controlled for that, you actually had positive GDP growth, and that the drop in imports in Q3 also gave a boost to GDP. That when we looked at the import components, the imports actually contributed to GDP growth by being smaller than they were the quarter before. Imports are smaller because imports were very high here, inventories were rising, which showed a drop in GDP, but here imports dropped, which showed a rise. So a bunch of accounting issues. You may be dealing with some accounting issues in Q4 as well. So, you know, Q4 could be high for no other issue. Then we still have some accounting issues to deal with in terms of the volatile components quarter over quarter. Could you show us what tracker should we use to invest in money market by using IB? I'm not sure what you mean by tracker. 3-month, 1 year, or 2 year. I'm in Canada. I've not been successful finding them. Okay, I don't know what you mean by a tracker, and I'm not sure why IB would be telling you which one you should invest in. You pretty much have to know it yourself. But if you're looking for where to find treasuries, on your main screen across the top, you have all of these little icons. You have this little arrow down button over here, right? And if you click on that, a menu will drop down. You'll see add more buttons. And when you highlight this long menu drops down, and here's the one you want, Treasuries. Click on that. It will add this little shield to your menu bar up here, and then you click on this, and a window will open up, and you'll have all the dates down here and all the listings of the particular security that you want. So you just then find what security you want, and you'll get a bid and ask for it. You click on it, put it on your watch list, click on buy, you'll get bid and ask, and off you go. Okay, would your housing analysis indicate that there is and will continue to be a high demand for construction skills in our labor market? Yes. How do I square that with indicators that there are fewer homes being built? Well, if you don't have the people to build them, you have fewer and fewer homes being built, right? Shouldn't that decrease demand for construction workers? If you listen to the home builders conference calls, there is still a problem with getting labor. That houses are taking longer to finish than they should, because it's a matter of scheduling the next layer of work that goes in, because you build your foundation and then you frame it, and then your plumbers, your electricians, all of them come in, they wire, and your HVAC comes in. Well, if you can't line them up because there isn't enough of them, sometimes you got to wait. For example, I had an electrician come and wire up my hot tub. Well, my hot tub arrived well before the electrician could, because, well, that's the way the bookings work, is you wait for them to show up. And they couldn't finish. They squeezed in just enough time to do the minimum, and they got to come back, but they're booked. So you wait. Next one. Historically, the inverted yield curve, depth length, eventually led to a recession. Well, you know, we're sort of saying cause and effect here. Preceded a recession. Every recession has been preceded by that. So let's just say precedes a recession. In these recessions, was an unemployment rate as low as we are in now? Well, we are not in a recession right now. So we're saying in these recessions, was it low as we are now? No. Recessions will increase unemployment. We are not in a recession now. We're expected to go in one. But we can say that the level of unemployment right now is historically the lowest it's been for a long period of time before almost any recession. Why the Fed has to manage inflation expectations even if inflation comes down? Well, let's assume that you expect 10% inflation next year. You will expect your wages to increase by 10%. It will be built into what you ask for. And if your manager expects inflation to be 10% next year, then prices will be 10% higher, because the plan will be that prices will increase by 10%. So once we expect something to be higher in price, we will then reprice our product in anticipation of that expectation, thereby creating the very inflation that we expect, right? So we don't want it to get into expectations. Also, if the Fed goal is to combat inflation, why does the Fed want to avoid a market rally? Because you want to keep financial conditions tight. So when the Fed raises interest rates, it's not the interest rate per se that causes the tightening of the economy. It is the cost of credit. So we're trying to decrease the amount of credit issuance by making it more and more expensive. What makes it less expensive is when you have a market rally. Because if bonds rally, then yields will drop. And if yields drop, well, then credit just becomes cheaper, because all credit products are priced off the Treasury curve somewhere, whether they're priced off the 2-year, the 3-month, the 5-year, the 10-year. They're all priced off the Treasury curve to some degree. Also, if equity markets rally, if we look at debt equity ratios, this is the market value of debt divided by the market value of equity for corporations. So as equities rally, the market value of equity rallies such that the debt equity ratio decreases, which increases the debt capacity of organizations. So for example, we saw today news that Amazon is issuing some $8 billion worth of bonds, and not because they need it, but because they can. That's what you want to try to avoid. You mentioned in one of your CFA Q&A live sessions that you only manage a portion of your money while the rest is being managed by wealth management firm. Yeah, so it's 1/3, 2/3. I manage a third, 2/3. Only because it's, you know, I've had a good life. I've been lucky in life, and I've got a significant amount. So it is a lot. And you want diversification not only in the securities that you hold, but diversification in the strategy that you pursue as well. So I invest and trade in a very particular way. I don't know that I want 100% of my funds invested in the same way. If you're going to invest in different funds, you like to get diversification among managers, diversification among strategy. So that's what this is doing. Plus, there is this money is in some investments that I simply could not get into. So there is some hedge fund exposure here. There is some private real estate exposure here. So I have investments in private REITs. They're not publicly traded, and I couldn't get access to that in other ways anyway. So yeah, that's why I do that. Due to time constraint, not really, because if your average position size is 100 shares and you double the amount of capital you have, your average position size is now 200 shares. It's not like it takes more time. It's just you have concentration of risk under one manager, concentration of strategy risk, right? And, you know, I'm not thinking that, you know, I'm immune to mistakes. I just feel it's safer. I'd assume someone who knows how to invest their money would manage all of it. I am thinking more and more that based on what I see here and the performance that I have, that I'm probably at some point going to shift some of this over here. However, I do have access to a whole bunch of investments here that I can't easily get as a retail investor. But some of them I can. So some of the equity exposure that I have over here, especially the North American equity exposure, I am thinking of canceling that and moving it over here, and I'll tell you why. All of these funds in here are relative performance, which means they have a benchmark. So they have to try to beat their benchmark. So if they're holding a particular security that will outperform in the next 2 years but underperform over the next 6 months, they get rid of it because they got to beat that benchmark. Well, I find that to be a silly reason to get rid of it. If you're holding it now and you think it'll underperform for 6 months, sell a 6-month call on it, or sell calls for 6 months before it performs. Well, they can't do that because it is outside of what their IPS does. So I have more flexibility here to do that kind of stuff than they have over here. So I may cancel some of these allocations and say just increase my allocations to the stuff I can't get and give me the rest. Okay, do you believe that TLT may be a good way to gain exposure to long-dated treasuries without going into options on futures? TLT is a duration-constrained ETF. It is based on the 20-year bond, so it is duration-constrained, which means that they will buy new bonds and sell existing bonds, even if it means selling a bond at a loss, simply because they have to maintain a particular duration. So that's why the yield that you would get off of the ETF is like a third or a quarter of the yield you would get if you actually bought the 20-year bond. If you can buy a bond in particular, that's probably the best thing, because you're going to get regular coupon payments, which are better than the dividend you'll get on TLT. Plus, if interest rates do drop, then you get the upside and you have the benefit of not having to sell it. If we think that we are going to enter a recession next year and that it's going to be more than just mild but moderate, if it's moderate, inflation will really drop, because nothing kills inflation like a recession. You may have the Fed dropping rates into the end of the year. That's where long duration or any kind of duration will help. So yeah, it's a good way to get exposure to long-dated treasuries if you have a 1 to 1.5 or 2 year holding horizon. But if you have a long-term holding horizon, I would recommend actually buying the actual bond itself. What are your thoughts on buying long-dated EWW calls for a Mexico play? Well, you're getting two things with EWW, right? You're getting the domestic asset return in Mexico, plus you're getting the currency return as well. Well, what happens if the asset returns in Mexico turn negative, but you have the positive currency return? It could be nullified or even give you a loss. EWW is quoted in US dollars, even though it is a Mexico play. It is a combined Mexico asset and currency play at the same time. I don't know if it's as pure as a Mexico play. I prefer just the currency directly. Also, a 2-year bond, even a 1-year bond, even money market funds in Mexico are upwards 9.5–10%. Get some of that. You get a 2-year at 9.5%. With Mexican currency, even if you are funding it with US dollars. The US rate is what, 4%? The Mexican rate is 9.5%. It's still a carry trade, although I would probably just buy the Mexican bonds directly. How would you define your own personal trading strategy? Opportunistic. I've seen you use equities, derivatives, and currencies. It's a combination of a lot of things. I have some holdings that I plan to hold for years. So the positions I'm building in the U.S. home builders, I plan to hold those for years. When I use SPY to sell options on SPY, I'm using it more as a hedge to hedge some longer holding long positions. That's opportunistic. I'll step in when I think I need protection, and I think as we get closer and closer to the end of the rate hiking cycle, there's less of an opportunity to get protection that way, and more of an opportunity to start thinking about interesting plays that are trading at very low multiples of earnings that I think are more than sold off and long term. So I'd say it's a combination of strategic, tactical, which is opportunistic. And I don't limit myself to any one particular asset class. If there's an opportunity in commodities, I'll go there. If it's in equities, great. If it's in currencies, I'll go there. The long peso position I have has been paying off beautifully. It's just been a winner. So I do plan to continue holding that one. I just wish the Canadian would come along for the ride. I'm almost ready to give up on my own country here. Is there anything to be taken from leadership of the recent rally? It has been led by some of the smaller sectors. Whenever you do have rallies, usually the most beaten up sectors will perform, especially the most beaten up value sectors. And you're pointing to materials, industrials, real estate. You can find a lot of good value plays in there that have very low multiples. Tech and communications still have very high multiples. Consumer discretionary is not something you want to step into in an inverted yield curve or in front of an inverted yield curve, because if you do get a recession, that sector is hit the hardest. Consumer staples is a safer place to be. Utilities is a nice safe to be. Healthcare is always a safe place to be, but consumer discretionary usually gets hit harder than the general market. Everything you said sounds very bullish for TLT. Do you see many downside risks for long-term treasuries over the next period? If so, what would these be? The risk to duration is higher interest rates. That's the risk. So whatever would lead to higher interest rates, that's a problem. So let's just think about what would lead to higher interest rates, especially on the long end of the curve. Inflation expectations increasing without a recession. In other words, interest rates will continue to go up because inflation expectations are going up, but you don't get a recession, which would give a reason for the Fed to lower rates. Increasing interest rates because of increasing inflation expectations, raising interest rates in front of an inverted yield curve without a recession. I put the probability on that to be so low as to be non-existent. Next one, off topic, but have you ever done a video on tax efficient ways of investing in an RSP and the nuances of investing through REITs and RSPs? Well, REITs are tax favored, so they don't pay tax. So when you get a dividend from a REIT, it is equal to interest on bonds, which means it's taxed at your full tax rate. So that is something you'd want to put in your RSP. The better place for REITs is a tax-free savings account. If you have access to a tax-free savings account, because you're not taxed at the REIT level and you're not taxed in the TFSA. So there is no tax ever all the way through. It is the most efficient dollar you'll make. In your RSP, there is no tax in your RSP, but when you take it out, it's all taxed at your marginal tax rate. So there will be tax at some point on that. So RSPs, I seem to think that you may as well just hold bonds in RSPs. And if you have a tax-free savings account, max it out every year with REITs, because no tax ever on anything, even at the corporate level. And well, there's a limit to how much you can put in your TFSA, so you put the rest in your RSP. How to decide between bonds versus fixed income in ETFs mutual funds? It depends on what you're trying to get done. Also, for many people, it depends on access. For most brokers, you can't buy bonds. With Interactive Brokers, you can buy bonds, but some people aren't comfortable buying bonds without having somebody sitting beside them saying, yeah, this is how you do that, click on this, click on that, off you go. If they've never bought it before, they don't want to make a mistake. If it's short term, you can go with money market ETFs or money market mutual funds if it's short term, because the management fee is not going to kill you. If it's something more long term, especially for bond ETFs, most bond ETFs are constrained duration ETFs, which means they do have to sell bonds at some point to maintain their duration target, so they will take capital losses. That's just because that is the duration that they want. So that if you want a better return or the ability to hold, it's better just to buy the bond. I'm interested to know which schools of economic thought you think has or have the ideas and theories that are most important for advancing society and becoming a better investor. Well, you're using the "and" here, so it seems to me that both of these things must be true. This is just strict logic, right? Advancing society and becoming a better investor is only true when both of them are true. Why would you care if both of them are true? And why would you care whether or not the economic system advances society? Being a better investor is understanding the system you have and profiting from the system you have. Advancing society is on you. You then take your money and you decide how you want to advance society. All too often we want to offload our social responsibilities onto the economic system, onto businesses, onto government, onto other people, but not me. You do it, not me. I'm going to call you out for not being good enough. But if you want a better society, it starts with you all the time. It starts and ends with you. And if everybody adopted that, well, then there you go. There's your better society. But when everybody wants to offload responsibility for a better society onto the government or onto the economic system, you're never going to get it. You're never going to get it. Becoming a better investor has nothing to do with having the optimal type of economic system. And becoming a better investor has to do with understanding the economic system you have. That's all you have to do, is understand it. And if you can exploit that economic system for profit, well, then it's on you to share that profit with those who cannot do it. You be the driver of change in society. You advance the causes in society. The problem with offloading it to government is whose ideology? Yours or mine? What if it's my ideology and you don't agree with it, right? That's the problem I have with companies being socially or trying to pursue social causes. It's like, well, wait a minute, whose social causes? Those aren't my social causes, they're your social causes. And they may not be every investor's social cause. So, every investor is looking for the maximum return. But once you start putting social causes in there, it's like, well, maybe I don't support what you're doing in that respect. Why not just focus on the best return you can give me and let me pursue my social causes? In the end, though, nothing beats liberal capitalism. A liberal capitalism as opposed to what is called classical capitalism. In classical capitalism, there is a strict division in society where you have a group of people at the top that own capital, and they derive all of their income from capital. And you have a large group at the bottom that derive all their income from labor. So these would be called the bourgeois class. This is the proletariat, and this is what Marx saw. And he saw class struggle all the time because you had huge inequality from the bourgeois and the proletariat, huge inequality in terms of the spread between income, but also in the type of income earned. Income here was earned predominantly from capital. Income here was earned predominantly from labor. That is not the case in liberal capitalism. In liberal capitalism, you have a classless society, which means that if somebody is born at the very bottom, they can rise all the way to the top. That is in contrast to societies which are caste-based, and I'll spell that out so you don't think it's class, that are caste-based. You don't have upward mobility. And there are some different social structures and economic structures that if you're born into a particular strata in society, that's pretty much where you're going to stay. It is not liberal in the sense that it's not inclusive at all the levels. Liberal capitalism has the least amount of inequality, and it has the most liberal distribution of income in terms of capital and labor. The capital is not all concentrated at the top and labor all concentrated at the bottom. It looks more like this. So this is capital, and this is, this is labor. The bottom 10%, 20% probably have no exposure to any kind of capital income, but a lot of people do. If you have a job and that they contribute to a defined benefit or a defined contribution pension plan, you have income from capital. If you have a job and there is a deduction from your paycheck for a state-sponsored pension plan, you have income from capital. It is a lie to say that the top 10 or 20% have exposure to equities. It's more like 70 to 80% of the population have exposure to equities. The participation rate in the U.S. is 62%. That means 62% of the population, the population, because it is a participation rate, 62% have exposure to income derived from capital because they have state-sponsored pension plans, right? Liberal capitalism plus democracy is the best. Liberal capitalism does not create inequality at all. Liberal capitalism solves the inequality problem. What creates inequality when you have a system of liberal capitalism and democracy, what creates inequality more than anything else is free choice. You want to eliminate inequality, ban free choice, and you will eliminate inequality. And I say if you want to really do a good job, have some cutoff level of income. Let's say it's $50,000 in the economy, and if you make less than $50,000 per year, you are not allowed to make decisions for yourself. That you have to report to some government office, and they will tell you how to spend your time, what you can buy, where you can go, who you can associate with, how you divide your time between entertainment and education. You lose all free choice. And if you did that, you would solve the poverty problem in 1 generation. It's free choice that leads to inequality, not liberal capitalism. Next one, I think there was a little bit more. They appear to rely more on moral and philosophical principles than on purely economic reasoning. One favors Australian economics because he or she values freedom above all. Again, to be a better investor, who cares? You don't really have to pick a system. You just have to pick the type of person you want to be. There you go. There's a step towards a better society. To be a better investor, just understand the system you have in all of its advantages and disadvantages. And then you can exploit that system for profit, and then you determine how to make a better society with the money that you have. If you feel that, no, I'm not going to do it with my money, then you are part of the problem. You're not part of the solution, are you? What are the implications of dividends on a short position in a stock? You pay them. Does the holder of the short position have to pay the dividend to the lender? Yes, you do. If yes, does this create a cash out transaction on the payment date? On the ex-dividend date, it gets eliminated from your account. Is there a reason why the Fed minutes are not released at the same time as the FOMC meeting? Somebody is making notes about the minutes, and then it has to be written up. Typically, minutes from the meeting are not just released. Even any committee meeting that you go to, there'll be somebody taking minutes, and minutes are just never released. Somebody then compiles the minutes, and then the minutes are distributed to the people who were in attendance to fact check the minutes in case something was written incorrectly, where there might have been a note made by the minute taker and somebody says, I never said that. That's not what I said. You misunderstood what I said. So they have an opportunity to make sure that the minutes are in fact correct. And then usually at the next meeting, on the opening of the next meeting, there's usually a vote to approve the minutes from whatever the last meeting was. Typically, that's how it works. So it would be rare that you'd have all the minutes done, written up, typed up in proper paragraphs and sentences in proper form, and vetted and checked and approved and voted on before they're released. So it just takes time to get that done. Okay, I'm going to keep going with the questions here. I do have somebody working in the basement building a door from one room to another room, so if you hear some banging or hammering in the background, that's what it is. Thank you for your great videos and weekly market updates. Got a question on Fed achieving a soft landing. When was the most recent soft landing being achieved, and how would the economic indicators look like as compared to a hard landing? The most recent one that they can point to, and I have seen a presentation by one previous Fed official, was 94.95 in the U.S., that was a soft landing. Inflation was above 2% at that time. Bond yields were 8-9%. Mortgage rates were 8-9%, and they pulled off a soft landing at those levels. But we have to understand that an economy is an ever-changing organism, so that at any point in time, we can't just say, well, the statistics look like A, B, and C at that point in time. We're nowhere near A, B, or C, so we'll be okay for a soft landing. No, this were the statistics of an economy at that point in time. Whatever economy you have, individuals within that economy grow into the size of that economy, so that changing it will cause dislocations no matter what. So we can't just look at the statistics and say, well, they're the same as they are now, or they're different, or they're higher, or they're even worse than they are now, so we'll be okay. You can't look at it that way. This was sent to me in an email here. What are your thoughts on increasing the inflation target from 2% to 3% for developed markets? And what might be the chances of this happening in the midterm? Could this be telltale sign? What could be the telltale signs to look out for? Goldman Sachs recently published a report analyzing various implications, but the bottom line seems to be that from the long-term investment portfolio point of view, any changes in target inflations above 2% are negligible. Well, I mean, you can target whatever inflation rate you want if you believe that the short-term interest rate and the controlling of M2, the money supply, can actually affect the inflation rate. If you believe a monetarist perspective that the inflation rate is a result of monetary policy and not a result of economic activity, then it would matter what your inflation target is. But if you don't believe that, which I don't believe, by the way, then it would not matter what your inflation target is. The real economy will be what the real economy is. I seem to think that if you are moving the goalposts just because the game has changed, it's sort of an admission that, hey, we can't get this stuff to work. So rather than getting the economy to come to us, we'll just keep moving around with the economy. I think it would show sort of a lack of credibility, or a loss of some credibility, if the Fed suddenly started changing just because it wanted to chase the economy around. I think that would cause a lot of problems in the bond market in terms of, well, how are you going to start pricing risk now? What are the long-term inflation expectations going to be now? So no, I wouldn't agree with it. What are your thoughts on ESG investing? I have no thoughts on it. I think it's a ridiculous thing to do. To actually pursue it, I think, is ridiculous. And here's the thing: if you stopped paying attention to things, you would get what you want. It's when you start paying attention to it and you start trying to engineer a certain look, it comes off as shallow, it comes off as phony, and probably higher cost than it needs to be. So I am not a big fan. Let's just take the G out, by the way. And we'll put E, I'll put 70% on E and 0% on S. All right, so governance, you need governance. If you had good governance, you wouldn't have had Enron, you wouldn't have had FTX. You need good governance, and I don't think anybody can disagree with you on governance. Nobody. So really, our problem was with the E and the S. The environmental. Look, if you can stop dumping chemicals in the river, well, that's a good thing. There's nothing wrong with dumping, with trying to find a way to avoid dumping chemicals in the river. If you can find a way to be more energy efficient and increase the bottom line, well, that's a good thing. But just to become more energy efficient so you can check a box, but it's going to cost you a lot more than it did before, I disagree with that. That's the easy way out, and that is incompetent management that simply just says, listen, it's going to cost us more money to show you that we're this. Yeah, you'll underperform. It's the S that causes the biggest problem. And S is built on extremely faulty assumptions. They're built on, especially the S that we have today is built a lot on Marxist assumptions and postmodernist assumptions. It's built on the false narrative, and there is no evidence of this whatsoever, the false narrative that we live in a patriarchy, that there's this patriarchy that controls everything, and it's a power structure. Both of those are faulty assumptions altogether. Everywhere I look, I see a matriarchy. I don't see a patriarchy. I mean, if you look at the family dynamic and look at your own family dynamic, look at everybody's family dynamic and just say, who's the one person, the glue of the family that holds everything together? It's predominantly a woman. If you go to any household and you say, listen, when you bought this house, who really made the decision? Like who was the big decision maker in the biggest purchase of your life? It's predominantly the woman. Find a married couple where the husband bought the house that the wife didn't like. You're not going to find that. Happy wife, happy life. The woman pretty much makes a decision. In almost all households you enter for household finance, who pretty much controls household finance? Predominantly the woman. When you go to court for a divorce and you're looking for custody, who predominantly wins? The woman. I see a matriarchy everywhere we look. Now you may point out, oh, well, hang on a second. Women are underrepresented at the top levels of organizations. Yeah, but that's not because it's a patriarchy. If you take a feminist perspective on this, the question is not how come women are underrepresented at the top levels of organizations. The proper question is how come more women are not willing to sacrifice every aspect of their life? How come they're not willing to sacrifice their friends, family, and relationships for their career? Why are more women not willing to make that sacrifice for their career? Answer, because it's not important to them. It's not the thing. Relationships, family, friends, they're far more important to women. That's why they're the glue that holds the family together. That's why they predominantly run the household, because that's more important to them. So if you are going to say we need representation of women at the top, you're going to have to accept that you're going to be appointing some who have not made the same sacrifices and have built up the same amount of experience as the male counterpart, because men are far more willing to throw away relationships and friends for their career. Far more willing. And there is some interesting research, end-of-life research, that looks at women and that looks at men and asks them about the happiness of their lives. And end of life, by a long shot, women are happier. Women are more happier than men because men have always sacrificed way too much. Always have sacrificed the important things in their lives, which is people and relationships. Women are smarter. They're less willing to sacrifice that kind of stuff. So the S part, especially for something like that we have this big class warfare between the genders, is built on a faulty assumption that women wanted that to begin with. So I agree with him on this one, that the ESG, if you're looking for ESG investing, you're going to find underperforming companies because you're not going to find as many qualified minorities in particular situations as you need to fill the roles and have the representation that you want, simply because of what is it? Free choice. If you go to any law firm and you look at the freshman group that they hire, or any university and look at the freshman group coming in, or any accounting firm and look at the freshman group coming in, you'll find it's roughly 50-50. And you'll find huge representation over here. But somewhere along the lines, because of the decisions that were made when you start to get to the top, because of the sacrifices you were unwilling to make for the company, yeah, that's what happens. So there is representation everywhere. But after representation comes free choice and the decisions that you make. I think that should matter more. We have a very representative society with a merit structure, not a patriarchy with a power structure. That's looking at the world through a Marxist lens. And Marxists have to see class struggle everywhere they look. They have no choice because that is the lens that they look at. They have to see power struggles. Anyways, I think I went too far on that. My answer on this is keep the G, pay attention to the E, but get rid of the bloody S. That is a pure waste of time built on faulty assumptions. And if you want to know something else that's built on faulty assumptions, blockchain. The whole need for the blockchain and crypto is built on faulty assumptions. Right there. You need, if you have this, you got to have that, because that is the only payment you're going to get for a distributed database. Somebody has to process something and you have to pay them with something. This has no reason for existence. None. It's built on a faulty assumption. Number 3, do you perform valuation for individual companies for your personal portfolio? If yes, what are your thoughts on capitalization of R&D expenses? No, absolutely not. Sales and marketing expense? No, absolutely not. Recruitment and learning expense? No, absolutely not. For tech and service companies. Meldrum's latest blog about Meta, I read that one. Here's the problem with capitalizing R&D research. Not all research leads to cash flows. So let's say that I'm going to engage in research and I start capitalizing some expenses and it doesn't lead anywhere. Well, what do I have? An impairment charge. So now, because I had that impairment charge, I had years of overstated income and a year of understated income. Then I'm going to try something else and I'm going to capitalize my research. Oh, impairment charge. And maybe one of them will work out somewhere. Now this one worked out. Now there's cash flow associated with this. Well, there we go. Well, let's say that I can't make earnings. Let's say I'm at the end of the quarter, I'm capitalizing my R&D, so on my balance sheet under assets, you see R&D capitalized for project 1. Great. I can't make earnings, or I'm not going to make earnings, so I say, well, why don't we just take another 10% of overhead and say it was R&D. No one knows. No, it's like billable hours from a lawyer. How do you know? No one knows. It's fantasy. They could just make that stuff up. Well, you can make stuff up. Companies will never miss earnings because you'll have this account sitting on your balance sheet that'll be a catch-all for anything and everything you need so that you can consistently make earnings. And then every now and then you have a big impairment charge, but this impairment charge happens after operating income. It happens lower on the income statement, so you'll always be valued based on operating income, and all these impairment charges will show up down here. Does that make sense to you? As soon as you open this up to capitalizing this kind of stuff, you will have companies that will never, ever, ever miss earnings. Ever. So no, I don't agree with it. If you think that some of these expenses should be capitalized, then you do it after. Don't let the company have the ability to classify their expenses as assets. You can do it after. You can then restate their balance sheet and say, well, these R&D expenses really should be capitalized. Is the metaverse going to be something? I don't know. You know, Zuckerberg thinks it is, but I mean, you don't know. You don't know that it is or isn't. And if there is an impairment charge, let's say you have 7 years of it and then you have an impairment charge. Well, overstated income in all of these years, understated income. Based on the matching principle, shouldn't some of this be matched to previous periods? Well, that would require a restating of your income for those particular periods of time. And if you are taking impairment charges, again, based on where they show up on the income statement, you risk less sophisticated readers of those statements ignoring that, thinking that, well, I'm just worried about, you know, let's look at operating income and we'll worry about our operating margins, and all of that is nothing below it. No, I think you open a Pandora's box of fraud and deceit on statements. Even an auditor, how's an auditor going to verify that? You capitalized $1 million in marketing expense. Well, maybe 900,000 was for you know, something, and 100,000 was in the current period, but I need to make earnings. How are you going to pull that apart, right? So no, I absolutely disagree that you need a change in accounting. What you do need is a little bit more understanding from the analyst perspective. And if you're not getting that, then become an analyst yourself and make the case, much as he did in his blog post. But to advocate for a change in accounting rules, I disagree with that 100%. Okay, regarding stepping into a spread as mentioned on the applied series, do you believe that one can execute the strategy with puts too? Buying a long-dated put and then selling a call one standard deviation out when the underlying goes up, and selling a further out of the money put when the underlying goes down. Yeah, you can step into that. Do you believe this strategy is too risky? You have to deal with assignment risk on the naked call potentiality. Well, I mean, if you're not comfortable selling the call, you have to have a belief that upside is rather limited and that we're heading down. It is much easier to hold that belief on ETFs because they represent a portfolio of companies. Much more difficult on a company, very hard to do on a company, because you don't want to wake up on a Monday morning and find out that your company was the target of a takeover and it's up 30 bucks in pre-market and you're dead in the water. So selling calls on individual names can be very, very risky unless they're extremely overvalued. Selling a call on an ETF, well, ETFs don't get taken out. You're not going to wake up and find out that Berkshire Hathaway has bought the ETF for $23 billion more than its market cap. It's not going to happen. So on the ETF, and the bigger the ETF, the more certain, not certain, but the higher the probability you can have that upside may be limited based on whatever analysis you have. I mean, you're buying puts, you must believe the upside is limited. Otherwise, why waste your money buying puts, right? I'm a CFA charter holder. Good. And something is going on in my mind. I use your L3 prep materials, but I think I have a lot of learning gap in finance, and sometimes I doubt my knowledge. How to tackle this? Constant learning. Always constant learning. It never ends. Just when you think you know something, keep reading. You'll learn more. Every Federal Reserve has a research link on their site where they publish their research. Read the stuff. It's all good stuff. You're part of CFA. You should have access to the Financial Analyst Journal. Read that. That should be your reading material. Constant learning. You should want to read more of this stuff. If you're interested in particular industries, lots of sites, .orgs for every specific industry, which has a bunch of research for that particular industry. Another issue is I moved to the U.S. this year and previously worked in a commercial bank in Bangladesh as a credit analyst. I really don't know which job sectors I should try to get into at my age. Don't worry about your age. Worry about what interests you and what you're good at. I feel I have broad knowledge of finance but not expert in any specific sector. Well, become an expert, right? Feeling really frustrated. Hear your market outlook. I have a love for finance. I feel sad when I think to change my career to another sector. Well, if you want to stay in credit, stay in credit, but become an expert in credit, which means you're going to have to do some deeper dives. You're going to have to do a lot more reading of research, and it becomes addictive because as you're reading one paper, you'll find a piece of the puzzle where you've always had a bit of a question or you didn't quite know something and think, oh, okay, that's interesting, and it makes you see other parts of your sector more clearly. Everything you read has value, everything. So get addicted to learning, get addicted to becoming an expert, as opposed to saying, well, I've done my charter and now I'm done and I'm not an expert. You recognize you're not an expert. And we live in a world of, I'm going to write that word down again, free choice. Choose to be an expert. You're not restricted. Choose to be an expert. And then take action. You nailed it in November being the last expiry for good SPY option premiums for some time, considering the IVP where it is now. What was the rationale for your expectation? Well, I just saw that volatility was coming down on yields, and when volatility drops on yields, it's going to drop on the market as well. And volatility was expected to drop on yields because you can't keep raising interest rates 75 basis points at a time. You did it 4 times in a row. You can't keep going at that rate. It's not a sustainable or a wise rate. And based on the minutes, and what Powell was saying at the last press conference was that it may be time to begin to let the cumulative effect of all those rate hikes do their job, because it does work with a lag. They don't know how long the lags are. They really don't, but they know there's a lag. That's the one thing they know. They just don't know how long the lag is. Well, they want to get to sufficiently restrictive and then hold it there for a while and let that do its job. So I knew that at that time, well, didn't know, but had a very good feeling that the rate hiking cycle was coming to an end. Another 50 with a 25 and a 25 maybe, but that will begin to lower the volatility in the Treasury market, which will then lower the volatility in the equity market. And if you lower the volatility, that implied volatility comes down. It's not going to be that exciting to sell premium at that point. It's not a matter of there was some signpost where I said, aha, this is it. It is a mosaic. It's evidence from here, evidence from there, pieces of this, pieces of that, valuations on components in the S&P, a whole bunch of things you bring together saying, based on the lay of the chessboard, this looks like my next best move. Okay, why would you not solely use the conference board leading indicator to assess the projected phase of the business cycle? Do you think this measure is not the most efficient? No, I think it's an important measure to use. What's nice about the leading index is it is an index of a whole bunch of indicators that are considered leading indicators. So you're not just looking at one indicator, but a whole bunch of economic indicators at that point. So you can rely on the leading indicator. I would also look at the coincident and the lagging indicator to make sure, if we say, okay, well, if we're in a slowdown, the lagging indicators should say we are in expansion. The lagging indicator should be expansionary. The coincident indicator should be somewhere between expansionary and slowdown if you think we're in the slowdown. So you want to use as many as you can to triangulate. So you can get a very good idea that we're in a slowdown. And you may say, well, let me look at the yield curve. In a slowdown, the yield curve should be inverted. It is. Well, that's just more evidence, right? We should look at other things as well. Well, what are some of the other things we would expect to see in a slowdown? And if you start to see those things, you get a higher and higher and higher probability that you are, in fact, in a slowdown. And this is a game of probabilities. This is not a deterministic thing that we play. It's not physics. It is an evolving organism. That's what the economy is. So every time the economy is in a slowdown, it's not exactly the same thing as it was the last time it was in a slowdown. That's why the more we have that we can look at, I mean, don't take 4 weeks to figure out you're in a slowdown, but if you're looking at economic indicators, if you're looking at financial market indicators, if you're looking at credit indicators like the shape of the yield curve, you're looking at a number of different big classes of indicators, and they're all saying the same thing. Well, then you have the basis of a very solid trade. What literature do you suggest besides your top-down course to complement business cycle subjects? Any textbook on macro. If you understand the macro, and when I say macro, make sure it is Keynesian based, because that's really the system under which we operate and the belief system, because your policymakers and your central bankers will act as if that is actually the true case, and you want to know how they're going to act, and understand that whatever you're looking at in macro are big generalities. Okay, they're simplifications of reality. They're not meant to look like reality. When we look at a model that's a simplification, all we're doing is saying, is this useful for helping me make a decision? Even though I know it's not a real representation of the economy, but the better you get at macro, well, that's the whole idea of top-down as well. And business cycle analysis is macro-based. Okay, in your applied course, do you have any plans on adding a quantitative methods section? Not really. I'm interested to see how to quantify certain things like seasonality, and also determine if one variable leads another rather than coincident. For this, you're looking at time series, a time series analysis, which you can get in level 2 quant. So you can buy the level 2 quant section, and it'll lead you through regression. Regression takes a bunch of different variables at a point in time. Time series takes a variable at different points in time. So if you want to know if one time series leads to another time series, you find another time series and you just lag it by 1. So if this is time period t, and this is the thing you're trying to predict, you would have the independent variable as t minus 1 on the other time series to see if it predicts t. You just lag it by 1. But you can get that in time series. I'm specifically interested in whether high-yield corporate bond spreads can provide a signal for equity markets, and how to determine the lag and significance of the signal. And if you're ever doing any research, you always look for secondary sources first, because I guarantee you, whatever research question you have, many people have had the same thing and have done it, and there's a paper written on it. So why redo it yourself? Most of these papers, especially good journal articles, are peer-reviewed. They're done with decent rigor, and they probably have a lot deeper knowledge of the methodological process than you do. Google it. Go to Google Scholar and Google it. Try to find some existing research that's already been done on that. Thank you for your weekly insights. I'm wondering, given that the Fed has indicated that they're going to slow down and eventually stop hiking rates, increasing mortgage applications, still increasing home sales, do you think it's a good time to start building positions in agency residential mortgage-backed securities? Yeah, I think it is. When agency fell below $7, they were down to below $8, $7.80. They got all the way down to $7.32. I was buying down there, buying blindly, because that was just a ridiculous price to be. This was on the after earnings on the opening that morning. It just sold off, and I saw the earnings and I go, I don't know why you're selling off. You're probably looking at net income. For agency, for any mortgage REITs, net income is absolutely meaningless. You have to look at the net income, the net interest income. Net interest and spread income is what you're looking for, and it was a record. So why it was sold off, I don't know. But now agency is what, $9.50 to $10. So it's had what is that? Almost a 30% rally in what? That's 5 weeks. If you have access to the applied series in the bottom up, I did a video on agency when agency was still sitting around $8.50 a share. And I made the case that now is the time to start thinking about a position in agency, because if we expect Treasury volatility to drop, the spread between the 10-year Treasury and MBS, which was at a really wide spread, is going to start to decrease, which will drive up the value of MBS. So you missed that one. The next one going in there is DHI. And that one will be in about a week or so. I'm just getting through the level 3 AM exams because they're being released December 15th for the February exam cycle. So I have to balance, you know, my own project with what with the obligations I still have to the CFA side. But DHI is the next one. DR Horton is the next one going up from a bottom-up perspective. If I wanted to, oh, by the way, if you're interested in agency, Annaly is also a good one to look at as well. NLY, I believe, Annaly. They're agency-backed, more MBS as well, or agency MBS, not agency-backed. If I want to assess the performance of factors in the market, do you believe returns on factor-based ETFs are a good proxy for factor performance? Not on their own, no, because they will have beta. They'll all have beta because, so let's say you find an ETF that is a small cap growth, and you think, well, I've got the small cap growth factor. You also have the beta factor. So you would have to look at that, and you would have to take out whatever the performance on SPY is, and look at the difference between those two. You don't have to subtract the risk-free rate because if you're taking out the return on the ETF you have and taking out SPY from the return that you have, it's the same as taking the risk-free rate out of each one. So just look at the performance of your ETF versus SPY. So if you're looking for factor performance, you're looking for factors that are going to outperform SPY. Unless you're looking at a pure factor, and a pure factor ETF will be set up such that it'll have long and short positions so that its beta is very, very close to zero, and it will only have just the size factor associated with it. So you might find those. I don't think you would find those kinds of ETFs. I think if you're looking at small cap growth, it's probably a bunch of small cap growth companies which have beta. So you have to look at it in relation to beta. And that'll do it for this week.